Hello guys, welcome back again. If this is your first time in our course, please know that there are other videos prior to this one, and I would really appreciate it if you can watch them, subscribe to our channel, like the videos, and share them with your loved ones. Find them under our channel named Onyx GM Analysts. Okay, Onyx Global Market Analysts. Onyx GM Analyst is the name that we are using on all platforms that we are available at, and you can find us, just by searching the name. So without any waste of time, guys, let us dive deep into our course. Kindly take some time to read the disclaimer here so that you may understand the risks involved. Unit 2 Part B. Here, guys, in Unit 2 Part B, we are going to be learning some of the most advanced patterns when it comes to the market. I know that they can be found on the internet, okay? You can search for these names and find them on the internet, but they are very advanced because they are the kind of patterns that are reliable and they don't just appear everywhere in the market any day. So somehow they have something special within them. Let us learn more about them. Number one, we have wedges, which are contracting. Number two, we have wedges again, but in this case, they're expanding. We have broadening patterns, which are called MEHAPHONES. And then number four, we have a cup and a handle. Let us look at wedges here. These kind of wedges that we are talking about here are contracting, meaning they are squeezing. You'll understand that as time goes, as I explain. So let us look at this pattern here. The market was rising, going up, and then when it got there, it turned, came to this point, it turned, it makes a break of structure. Then just after that break of structure, it goes up a little bit, it turns, goes back down, makes a higher low, and then from there it goes up. So as soon as the market makes this first point here turning, and then it gives us another second point and it goes down, you and I already know we can use a trend line to join those 2 points with it and then let it surpass into the future. Let it surpass into this right hand side here. Then just after drawing that trend line here, the market, it goes, as it goes, we check on the downside, do we have something that we can also use that we can draw our trend line on? Yes, we have this point here and this point there, and then we join this with a trend line. Now I want you to look at this. Check the higher trend line, which is a resistance, and then look at this one as well. You can see that the upper trend line was rising, and then this lower trend line is also rising. But these trend lines, if supposed we draw them to the future somewhere there, we extend this one, you can see that they are converging. They are not diverting, they are converging. In other words, they are contracting. And that's why we call this a contracting wedge. This is a wedge, a rising wedge, as stated here. It's a rising wedge. So rising wedges are contracting. But there is also a contracting, a rising wedge, which is expanding. So which means that in this case, we have something that looks almost like a triangle. If you can check a wedge, it looks almost like a triangle. And in this case, the upper trend line is rising, the lower trend line is also rising, but they are contracting. They are not parallel to each other. Okay, so as they are contracting like that, we call it a rising wedge. As you can see, the market has been rising, forming a series of higher highs and higher lows. So as soon as the market comes here, you're gonna check. This was the first point, second point that it touched, the third point, fourth point, and the 5th point. Normally rising wedges turns on the 5th point. Well, I'm not saying that it's impossible for for a rising wedge to turn maybe on the 6th or the 7th point, but what I'm kindly emphasizing is that there's a possibility, a very high one, that here when it touches the trend line for the 3rd time, I said for the 3rd time because on the upper side it was touching it has touched it, it touched it for the 1st time, 2nd time, and then here it's gonna be touching it for the 3rd time. But when you look at the overall points that are there, you see that it's 1, 2, 3, 4, 5. Okay, but you don't just sell when the market gets here. Remember what I always preach to you guys: you wait for a confirmation. As soon as you find that one confluence, it can be, a smaller pattern there, a double top, a head and shoulders, any kind of something that is going to be confirming for you that the market is about to sell, then you can take that as a signal and sell. But in this case, I want you to also be aware that there's a higher possibility also that the market can break this structure here, go to the outside, to the upside, come back down, and then drop. So this here we call it a fake out. A fake out is something that the market makers, they do to hunt the stop losses of other people that are participating in the market, or rather maybe there's a certain force that has moved the market and gave it a momentum to break the resistance or the support, but you find that the overall direction is still favorable to the side that is opposite to the breakout. Okay, so in this case, this guys is a rising wedge. The market goes up, creates a high, comes back down, higher low, higher high, higher low, higher high, and then comes back to break this support here, and then it starts to retest this trend line there. As you can see, it was retesting it, forming a small consolidation. It was retesting it with a small consolidation. So if the market retests with a small consolidation like this, you draw another smaller trend line, which we call counter trend line. Why counter trend line? Well, I'll not be explaining that. Okay, just know it. It's called the counter trend line. And then as soon as they break that smaller trend line, you wait for a retest, or maybe wait for any kind of a candle, because sometimes they may give you a FTR there. They may give you an FTR confirming the market structure, the market's momentum to the downside. So after an FTR, it may happen that the market never comes to retest again in a clear way that you are able to identify. Okay, so the market drops. As the market drops, you will look at the middle point. As you can see, this number 2 here, this was the low side of this wedge. Okay, this was the lower side of this wedge, even though we have a lower low here where the market was coming from. So this is where the wedge started from the downside, went up. That is our target. But for you who are not greedy, you can use the middle point, 50% from the breakout to this beginning of this wedge here. That 50%, you can use it as your target, and that's what I highly advise you to do, because you'll never know where the market will turn for sure. If we knew exactly where the market would turn, many of us would be the world's richest billionaires. So we don't know exactly where the market is going to turn. Remember, we are dealing with probabilities here. So in this case, you sold there. As soon as you sell, you already know. You put a stop loss above the most recent high, and then here's your first target, and then your second target. Now your third target is gonna be where the market was coming from as it started, as it was gonna be forming this wedge there. So check this out. On point number 5, remember what I said, you can sell on point number 5, because we know that most of the times in a rising wedge has 5 points which touches the end sides of the ends, which touches the trend line, which are the edges, which means the end sides of the wedge. Okay, so you can see here we have edge number 1. This is another edge where the market turned. This was an edge again, and then here there's a possibility that the market can turn and go to the downside, but you don't just sell immediately as the market touches that upper trend line, the resistance in this case. You don't just sell immediately. What do? You wait for the market to give you a confirmation, because sometimes what happens is that the market can give us what we call a fake out, meaning this was a false breakout. It was trapping people. In other words, it was inducing people to buy, and then if they could have bought there, they would put their stop losses below, and then as it comes back now, their stop losses were gonna be wiped out. So you need to be careful of such a thing. There's a high possibility that it happens. Okay, we move. We come to this one. The market was falling. As it drops, it turns, go up, drops, turns, and then we already have 2 turns on the lower side. We use those 2 turning points, draw a trend line, make it pass to the right hand side, and then the market, it goes up, comes back down. We have 2 points above, and then we use those 2 points above to draw a trend line, and then it drops. So you look at this trend line here, the lower trend line, it's declining. It was not inclining, it's declining. And then this one also is declining, but they are not parallel. They are contracting. They are converging towards one another. Okay, so what we call that? We call it a falling wedge. A falling wedge is bullish. A rising wedge is bearish. A falling wedge is bullish. So what do? We wait for the market to come and retest this point for the 3rd time below, and then we check what do we have as a confirmation. If you find a confirmation there, good for you. If you don't find any confirmation there, be patient. Wait for the market to break this upper trend line, which was the resistance, and as soon as it retests this trend line here, you can start looking for your buy entries, and then you put your stop loss below the most recent low. Okay, and then your targets, as I explained in this one, you look where is the this point here. You look at it. That was point number 2 of the wedge, because we have here 1, 2, 3, 4, and 5. So here at point number 2, that's your target. Point number 4, that's your target as well, because point number 4 is 50%. So why do I strongly suggest that you place your first take profit there? Because the market may turn before it reaches point number 2. Maybe you did not identify a trend well in a bigger time frame, or for whatsoever reason, maybe there's another force that is moving the market. There are many factors that moves the market, worldwide. There's so many things that happens that can end up affecting a certain price, to go up or to go down. So that's it, guys, with the wedges here. Now I want us to look at what we call here expanding wedge. Remember, in this case we spoke about contracting wedges. Here we are talking about expanding wedges. So this was a falling expanding wedge, which is bullish. This is a rising expanding wedge, which is bearish. Same explanation, guys. Point 1, 2, 3, 4, 5. Normally wedges have 5 points. 5 points. On point number 5, that's where we look for our entries. But suppose you don't find an entry there, maybe you were confused, or maybe you were scared to take a risk because you know that it may spike out to the downside and give you a fake out. You are just not sure. You can wait until they break this trend line above, and then wait for the retest, or wait for any kind of confirmation that will be signaling a continuation to you. Okay, so in this case, suppose we found an entry here and a beautiful confirmation. We are going to buy and put our stop loss below, and then as we put our stop loss below, you just have to put it somewhere a bit below. And I hope that the confirmation you find here is gonna be candlesticks having some wicks. Then you can put your stop loss below those wicks, and then you will use this trend line, the upper trend line there, as your first target. You can use it as your first target. use point number 4 as your second target, use this one here as your third, and then that point above as your fourth. I really don't know your kind of risk appetite, but then I'm just trying to show you something that can give you an edge because it's found in the market. These patterns, you can go back to 1990s, guys. You'll see them on the market. You can look at the market somewhere around 2008, 2020. You can look for these patterns in the market. You will find them on all kinds of time frames. They just repeat each other again and again. Remember, the market is fractal. Maybe you need to make a little bit research on that, don't you think? Sure. Now, let me explain here. It's the same thing. 1, 2, 3, 4, 5. And on point number 5, which was the third touch of that resistance there, remember, we don't just sell. We wait for a confirmation. If you can always remember what I emphasize for you guys, you will be on the right side of the market. Even if you may lose trades sometimes, but your edge, trusting these strategies, trusting these patterns, applying the principles and rules of take profits and stop losses very well, you are going to be on the upper side and your equity curve can be rising as long as you apply good money management. Thank you so much. Let's continue. Let's say we found something that gave us a confluence to sell there. We sell and then we put our stop loss above those wicks that we're going to be having there. And then from there, this is our first target. As the market breaks here, if the market confirms that it breaks, then we can, wait for another entry. Or maybe as the market approaches this level here, you may remove your take profit and wait to see. You may put your stop loss above the most recent high, which means you have locked the profits because you entered here and you're already in profit. If you put your stop loss there, it means that the market, even if it goes back up to your same level as your entry, when it hits your stop loss, this amount of money here, it's already secured. It's yours. Okay. So you lock your profits, that small profit, you lock it there, and then you let the market to fall. As it falls, you check. If it gives you an FTR here or that kind of a breaker candle, you wait for a retest or any kind of confirmation to the downside. You take an advantage of that and then you sell. Okay, just after selling there, you put your stop loss above the most recent high that was here. You sell. 50% can be your target depending on your risk appetite. This can be your target. That low there can be your target. But remember, trend is your friend. So if you find this thing happening and you find that the overall structure says the market is on a downtrend, maybe this was just a part of a correction, and maybe this was just a part of the retest, then you take an advantage of that, you capitalize. Let's move. Broadening pattern, we call it also a megaphone. Okay, this is a broadening pattern. It's a bullish megaphone. What happens there is that the market goes up, and then there's a high there. It turns, comes down, goes up, comes down, goes up. As soon as it has 2 points above, you draw a trend line there. It goes there. As you can see, this trend line there, it's inclining, but the trend line below is declining. So they are diverging. Okay, these two trend lines are diverging. In other words, this is not contracting, it's opening up, it's expanding, it's broadening up. Okay, but the psychology is the same. So I will not waste any time here trying to explain the same thing that I explained in the previous lesson, in the previous wedges. This is tradable just as much as a wedge. You trade it just like you would trade a wedge. Okay, this one here is the same, guys, as you can see. So let us not really waste some time here. I was just trying to show you that these patterns are there in the market. What you need to do is to train your eyes to see them, practice and practice and practice, because that is exactly what is going to help you to become better and better as you tune your skin. Let's proceed. We have something interesting here, which is called a cup and a handle. What is a cup and a handle? Well, a cup and a handle looks exactly like a cup. If you can check the structure here, the market went up, came down, but as it was coming down, you can see that this shape here, it's almost like that of a cup. You know, this was more like a drop base rally. Okay, but you look at it, you can see that no, it was like a cup, but it signifies itself more as it starts forming this little choppy kind of thing here, which was also a flag. You know, as you can notice, here's the first pole and then it consolidates, then we expect the second pole to the upside, but we don't just anticipate that and then start taking, you know, irrational decisions without seeing any confirmations, right? So look at it, guys, just learn how to spot it on the market. It's something like this shape, and then the market comes here to form what we call a candle, you know, a handle, sorry. So this is a cup, it has a handle, you see. So as soon as they break this candle here, the upside of the candle there, we start looking for our entries. Why? Because this cup is open to the upside, so it shows us that the market has a potential to go to the upside. Okay, so as soon as they break out here, we wait, and then if we see any confirmation here that signals for us any buy, we take that buy, we put our stop loss below the most recent low. It can be this one here, it can be that one there. Our target is gonna be from this point here of the cup to that resistance there. As you can notice, the market from the high here went down, from the another high here when it came up, and then started dropping. So those 2 points above, we joined them with a trend line. In this case, it was horizontal. It may not always be it may not always be horizontal. Okay, so it starts consolidating, and then after this mini declining consolidation here, which is a compression, the market starts breaking to the upside, and then it retests, goes up, breaks that main trend line. After it breaks that main trend line, you can scale in and add your trades here. When it retests, you check first if there's any confirmation, then you target this distance that is projected from the resistance to the downside of the cup and handle, just like that. Like I said, if you can really understand into depth the concept of breakout and retest, you'll find that so many patterns in the market, even if you can't identify them. For example, there is someone out there who understands the concept of breakout and retest, but he or she does not know that there's a pattern called flag, there's a pattern called cup and handle, there's a pattern called wedges. But as soon as the market breaks the trend line, they don't just jump in, they wait for confirmations of candlestick or whatever kind of edge they use, and then they buy on the same point where you could have bought with this knowledge, you know. So someone may call this something else. I may call it by my name, I may call it delight, you may call it by your name, you know, but it is what it is. You just have to see it, identify it, know how to enter it, know when to put your stop loss and when to put your take profit. So this, guys, is a bullish cup and handle. In this case, we have a bearish cup and handle. The market goes down and then it goes up after that point of turning, and then it goes down again, it turns a little bit, it goes up. In the downside, we already have 2 points, which means we can draw a trend line joining those 2 points. And then in this case, our trend line was it was horizontal, it was our support, and then the market started chopping, it started consolidating a little bit, made a correction here. As it is making this correction, we identify that there's something flaggy here. Even if maybe you were not able to identify this flag, you know, you can still capitalize out of it simply because of the rules and guidelines of breakout and retest. As soon as the market breaks here, goes down, you can see that, oh, we have a cup here, and then this is the candle and it's facing to the downside. So we take the distance from the support to the, you know, to that point of the cup, and then we project it to the downside, and that is going to be our target. And then our entry points, you will apply the same kind of rules that I kept on mentioning again and again ever since we started this course. Let's proceed. Oh, okay, guys, this is the end of part B. in unit 2. So unit 2 is closed from here, which means the only lesson coming from this one is gonna be practicals. Don't forget to subscribe, like, and share the video with the loved ones. And also, guys, remember, if this is your first time in our channel, please turn on the notification and stay tuned. Be blessed.